Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us at the MarketSite studio in Times Square, New York City for my last live hit of 2022, we have Chris Dearborn, Managing Director on Nasdaq's Market Intelligence Desk. Chris, it's great to see you as always, and not only are you my last hit for 2022,
Hoorah!
You're one of the first people I knew in trading when we started this, 25 plus years ago? A long time ago.
Yes.
And certainly...
We're not mentioning age.
We are not mentioning age,
Yep.
but we remember the dot-com boom and a couple of other things. And it's just so interesting how the market has evolved, how market infrastructure has evolved, how retail participation has changed tremendously. But 2022 definitely was an interesting year, not comparable to dot-com, not comparable to the financial crisis, really in a league of its own.
Right. It's a hangover that won't go away. It's basically what it is. And it's kind of funny that you talk about the come year end, but that's really what happened because everyone's waiting on the Fed right now. And that's just the anticipation. And it's not an overnight fix. It's not like the COVID lows where the market tanked and rallied back up. It's not the dot-com bubble with one after another of all those companies, Pets.com and everybody else, just kind of blew up and then we recovered with quality names. You think going back that time, Cisco, Microsoft, they were all cheap for forever. You could bought as much as you want in the 20s, Cisco in the teens. Meta, when they IPO'd after Facebook, was in the teens for forever, right? So that took years to work out, but that worked through other sectors as well. What you have here is kind of self-induced, and that's where we are right now. The markets keep looking for hope that the Fed is going to figure out what that terminal rate is going to be, get there, and then move on. The problem is the Fed doesn't know. They're backwards looking, trying to make forward-looking items, and between the COVID, the situation in Ukraine, supply chain issues which have been brought on by COVID, financial stimulus, the federal government just keeps printing money left and right. All of those factors, one or two of them would not be a big deal, but so much laid onto it that the markets just have that problem of when is this going to recover? And that's kind of where we are right now. They hang on every word. I mean, look at today's macro numbers, right? The third revision of Q3 GDP was revised up 3.2% from 2.9. I mean, that's ridiculous. And the market's tanked. That should be a very bullish indicator, right? Consumer sentiment yesterday, very strong, but the market still closed down. We're down, if you just look recently, the NDX has closed down 6 of the 7 last days. We're down 34% year to date. And if you look at the comments, nothing's fundamentally changed from Powell's statement. And that's where we are right now. It's tough.
Well,
But one last thing,
right.
You can't fight the Fed.
Right.
And that's when the markets have to look. You can't fight the Fed. They've been telegraphing what they're going to be doing. They just don't know how bad it's going to get or how long it's going to be, and you can't fight it.
Right, and you can't fight it on the way up when everyone's complaining there's no way to trade. It's only going from the bottom of the chart to the top right? It happens on the inverse as well. But here's the whole thing. Powell's been very clear, very articulate in the way his policy direction is going. The numbers come in better, which is bad news for the markets because it suggests that he's not going to reverse his strategy, which I don't think he will do anyway, because you don't want to run into what happened with the 80s when you reversed tax too quickly.
You had 20% interest back then.
Right.
I mean,
and so the market's interpreting everything that's good news is going to be bad news because we're raising rates for higher. The good thing we're not talking about tightening. That's a whole other story. But Chris, what the question is, when do we start talking about fundamentals? Because I personally think that we're going to focus on the macro at least until we get to Q4 earnings, which takes off, second, third week of January. But I think that's the next shoe that needs to drop, where it needs to rebase there, and then we start to, kind of turn the corner.
You're looking at second half of next year.
Right.
Second half. This has got to play out over the next 6 months. Because we got the P. We think. What's the E now? Right. Before you're saying, well, we know what the earnings are going to be. What's the price going to be? I think that's reversed. Stocks have bottomed so much, and the market continues to hang on every word. I mean, look at what happened out of Micron today. That's one of the major items that sank the market. Chips are leading lower, right? And that flowed over to hardware, right? Coming into December, where December is usually a plus month, right? We're down 11 out of 16 trading days so far, and that's including today, with only 4 more to go. Usually December is a plus differential, not a negative differential.
Right. Well, you and I could debate the fundamentals all day long, but of course price action is what confirms what's happening in the market. So let's pull up your first chart here. Let's take a look at some fresh technical levels to watch.
Right, so the NDX is trading around 10 we'll call it 10.8 right now, 10.8, 10.850 is where we're bouncing around. At one point, the index was down over 4% on the day. We opened at 10,800, a little bit lower. Probably about an hour ago, we got down to about 10,770. I mean, that's just ridiculous. What happened was last week, following Powell's address, after the 50-point bips raise, the markets started to sink because he really hadn't seen much better. What he did basically was he broke the market. The index had been range bound between the 50-day moving average on support and the 23.6 fib from the October lows as resistance. And for a month and a half, we've been range bound for that, waiting for a breakthrough. We all had our eyes marked on the December press release, and that's what happened. And we've been lower and lower and lower, right? That 50-day moving average is 11,400, 11,410, depending on the day. And we've snapped that pretty handily. So that means we're into a whole new mindset. And the index itself is really kind of on a bearish trend, as we all well know. Good news is bad news. GDP numbers, spending numbers, consumer confidence numbers, unemployment numbers, right? Initial claims were only a couple of thousand more than from last week, which was still less than what we thought it was going to be this morning. So support right now sits at 10,630, then 10,590. The 10,850 level is where we are right now. That's a resistance support level. If we close above that, it's a slightly more bullish tick on the intraday, but overall it's still very bearish. Next set resistance 11,100, then the 50-day moving average, which has been acting as support, is now resistance.
Before we get into your next chart, what sectors are leading, we can figure that out, or what stocks are leading, we can figure that out. We keep hearing Powell, well, I think 90, there's one up today in the Nasdaq-100, but regardless of the Nasdaq-100 or index you want to take a look at, keep hearing Powell broke the market, Powell broke the market. Well, you know, Chris, I would argue some of these stocks did not deserve to be at the valuations that they were with no paths to profitability, right? You know, coming up with these multiples that existed on projections 5, 6 years out, who knows what technology, and it's not exclusive to the technology sector. Maybe these valuations had to come in.
They have, but they're not where they are right now. Now I think they're looking a little too lower. Somewhere in the middle is the right. Analysts going back during COVID kind of looked at everything and had like a rosy, you put the rose glasses on and you look forward. But then the bears come out and they put the, oh, everything's in the garbage right now. It's somewhere in between. And where we are right now is maybe not, is an 18 forward multiple the right number now as opposed to a 19. Maybe it's a 15. Maybe it's uncertain to know without knowing how much it's going to cost to borrow money moving forward. Until that is defined, you will not have a firm PE, period. Until that happens, you won't be able to model correctly because it's going to change every month. Right,
that's a great point that you're making. Of course, how long will cash remain on balance sheets and what margins are going to look like.
Right.
Anyway, let's take a look at your last chart here. I mean, one
simple.
stock leading the way? Or
It's not, almost everybody's negative right now. Again, it comes down Micron with the chips leading everybody lower, and it's all the chips down. Like I said before, bled into hardware. So you've got Apple getting hurt, you got Tesla getting hurt, Microsoft on the software side is getting hurt, but then everybody else on top of it. There's really not much to look forward to. The Santa Claus rally, I think you might be calling the stocking.
Yeah. I mean, look at Calais, Lamb, all of them.
It's tough. It's a tough day. It's a cold day.
Yes.
It's a little damp in New York, but a lot of people are going to get cold. We'll see what happens next week.
That is true. All right, Chris, appreciate the insight as always. Thank you for joining us.
Happy New Year.
Same to you. And Happy New Year to everyone in the Trade Talks audience. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.